Chapter 18, Chapter 19. And basically, what the exam is going to be, and it'll be due by the end of the quarter, which I think is on the 8th, maybe? I think it's on the 8th. But what I'm going to do is combine and just have you guys do problems. That's really the the trickier part of this, is doing problems. So anyway, so tonight we're going to start in on chapter 18, handout on pensions, and then we'll combine the last two, and then there'll be a problem or two for each chapter. I'm leaning more towards one problem for chapter 19. I don't know. I'll take a look at it, but anyway, yeah. So we'll go ahead and get started. So chapter 19, handout on pensions. And pensions come in two flavors. We have the defined contribution plan, and this is what most people have nowadays. And usually it's some kind of a matching plan that an employee will say put 3% of their salary into this retirement plan before taxes, so it comes off their taxes. And a lot of times the employer will match it. So, for instance, if this is what's this? Oh, Lisa. If Lisa had a pension, she's paid $70,000 a year, and her employer puts 3% of her salary into the pension plan, she probably will too. That means the pension account will be paid. The amount the employer will pay will be $2,100. Now, Lisa may very well pay $2,100 herself into it, so $4,200 or whatever goes into the account. And this is very common. Nowadays, this is what you see a lot more of. So the defined contribution plan is where the amount that the employer puts in is defined. The much trickier one is this one, the defined benefit plan. And this is more difficult because it's paid almost like a lottery, to be honest with you. For instance, a defined benefit plan, maybe you'll pay retirees 60% of their final salary. Okay, so if Lisa was making $70,000 a year, her final salary, then she would collect $42,000 a year, 60% of it, for the rest of her life. Now, as you can imagine, this is a very large liability. That's a very large liability. That's in the hundreds of thousands. These can be in the millions of dollars. And these defined benefit pension plans they're getting fewer and fewer. They're still around. There's still companies that are paying them. There's still unions that are negotiating for them and all that kind of stuff. They're becoming more and more rare, and especially in business, they're almost extinct in a lot of businesses. But there's still some that hang around, and these, again, are huge. They used to not account for these. They used to not account for pensions. And it goes way back to when they first started giving out pensions. In the United States, people wonder why in the United States that our employer pays our insurance, our health insurance, and why they pay the pension. Usually it's paid into a government agency that handles the pensions. It also handles the medical expenses for people. In the United States, World War II is to blame for us having the weird system that we have, where the businesses pay those things. In World War II, they had a real shortage of trying to get people to work. A lot of people were drafted into the military and all that kind of stuff, and they couldn't get people. And they had a freeze on salaries. They said you couldn't pay people any more money than you're already paying because we don't want this inflation to go crazy. And so they couldn't attract people by paying them more money. What they could do is give them health benefits. Now, back then, health benefits were really cheap, and they'd hire a doctor to come on site, and there'd be a doctor's office. And if you or someone in your family had a problem, they'd go see the doctor on the factory, in the building where the factory had the doctor set up and that sort of thing. They also gave pensions. Now, the pensions kicked in when you're 65. At least the average male didn't live to 65. The average male lived to whatever, 62, 63 or something like that. It wasn't uncommon to have someone retire when they're 65 and die 2 or 3 years later. It was just the way it was. People drank a lot, people smoked a lot, people did a lot of things. There were no health clubs. You'll never see an old movie of someone going to a health club. They didn't exist. So, when they first started giving these out, it wasn't that big a deal. So, the actual liability of it was fairly slim. We got 100,000 people working, and we have 2,000 retirees. Okay, that's not that big a deal. As time goes on, the roles really switched. People started living a lot longer. And these pensions were still fairly generous, based on someone living, 2 or 3 years after they retire, whereas not 20 or 30 years after they retire. So they got to be these really huge amounts. And I was kind of in accounting when that kind of happened, when they started having to record these things. And many people thought that when they started recording pensions, that like every American company was going to go bankrupt because the liabilities were just massive for them. And I've told this boring story before. And if you guys had me in the advanced class, I've already told this story. But when I worked at Navistar, which used to be International Harvester, it was a tractor company that was around for 1,000 years or something. We had 11,000 employees, and we had 39,000 retirees. Every person working there, there was more than almost nearly four people retired for every one person that was still working in the place. The pension fund was way bigger than the company. Navistar's, the pension fund for Navistar was way bigger. And not only was it way bigger, they had 35 of them. Navistar had 35 pension funds. Anyway, if you worked at Navistar in any accounting function, you can imagine that you got to know pensions pretty well. I didn't understand pensions at all when I went through school. When I took the CPA exam, they didn't make any sense to me. I just memorized it because it was just, bizarre, and I didn't understand them. But anyway, now I kind of do. Actually, I think my first time actually doing a pension audit, it's one of those weird things that something looks so difficult, and then once you start seeing the numbers and seeing how they come from, and this is so obvious. Why didn't I get it? But anyway, it's until you go through that, it's really difficult. But anyway, so we'll go through this with the pension thing. And the one thing that's important to know about these defined benefit plans, the contribution plans are no problem. 3%, here's a check, 3%. Company's done with it. The defined benefit plans, it's how much they're getting when they retire. How long are they going to live? You have a lot of people almost like insurance people. How long are people going to live after they retire? They're going to live for 15 years or 20 years or whatever. And you actually have actuaries that come in and do this. The pension fund is considered completely separate from the company. So here's the company, here's the pension fund. Right? So they're two different things. Now, the company puts money into the pension fund, but they're considered for our accounting to be two completely different things. The pension plan and the pension and the company are separated. So, it's good to keep that in mind. The company simply writes checks to go into the pension fund. Now, everything else that takes place in this kind of other entity, this pension fund. All right, so they're kept separate. And here, I'll show you kind of what we're looking at. Okay. So here we have the employer. It could be anybody. Let's just say, I don't know, make up a company. Let's say this is Ford. Ford pays cash into the pension plan. And that cash goes into these plan assets. And they'll take that cash and they'll make investments and, you know, to try to make that cash productive. So these plan assets, how do they increase? They increase when the employer pays into the plan or when the investments have gains on them. How does the plan decrease? When retirees are paid or we have losses on the investments. So these plan assets, they get paid out to retirees. So if what's that? No, not Lisa. If Lisa retires, Lisa's going to get checks every month from this plan. So the employer is putting money in, that's going into assets that, you know, investments that hopefully make money. And then as the people retire, they get paid out of those assets. Okay, now, plan liabilities. This is a good thing to, you know, get to know right away. Projected benefit obligation. Like any liability, you know, this is a liability that we carry on the books. It has an interest rate, like a liability. How does it increase? When there are actuarial losses. I'll talk about that in a second here. And how does it decrease? When retirees are paid. So when retirees are paid, this liability goes down, just like you're paying any liability, it goes down. And there are actuarial gains. Now, these actuarial gains and losses, those come about because of changes in interest rates. You know, how quickly how quickly are these benefits growing or shrinking, that kind of thing. Those actuarial gains and losses are generally changed by whatever the actuary uses for the discount rate on. And if the interest rate goes down, this is when you gotta start thinking like a finance person. When the interest rate goes down, that liability goes up because the payments are the same, but it's for a bigger liability. So, and we're not going to get into that, but CPA firms and the auditors do not get into that. There actually are actuaries that will come up with these numbers for you. They're professional, licensed, and all that kind of stuff, and they'll give it to you what those numbers are. They give not to the auditors exclusively. They give it to the company and say, "Hey, here's what your, you know, here's the actual actuarial, you know, gains and losses and liability and all that kind of stuff." So they work that out. It's almost like an insurance company. It's heavy statistics kind of thing. So that's what the pension fund is. They have a whole bunch of assets. They have a whole bunch of liabilities in there. Now, here we go. Okay, so the projected benefit obligation, this is funds that are calculated at future salaries. And these liabilities are the future payments to pensioners. And the plan assets are the fair value of the assets that the pension has. Now, it's not uncommon to have, oh, I do it here. I'll do it on the side here, I guess. For instance, let's say that you have planned assets of, let's say, I'm just making up. Let's say you have planned assets of 5 million. And you have planned liabilities of 6,200,000. Okay, and I mean, I just make those numbers up. Is this plan overfunded or underfunded?
Underfunded?
Yep. This would be underfunded. Oh, I don't know what I just did there. Well, yeah, it's underfunded. Despite what my crazy, I can't do it here. I can. All right. So this would be what they, you'd call an underfunded plan. There aren't enough assets to completely cover the liabilities. Many plans are underfunded. When I was going through, they were underfunded a lot because the companies just didn't have the money to fund them. Over the years they've kind of caught up, but a lot of times they were underfunded just because it was such a huge liability that kind of caught everybody off guard. Nowadays, a lot of times these are underfunded because of for tax reasons. These are huge dollar amounts. So the IRS is very persnickety about how much you can put in. What they don't want to have people do is throw a bunch of money into the pension fund and say, look at all these expenses we have. So we don't have to pay any taxes because what they're really doing is paying down a liability early, according to the IRS. So a lot of times these funds are underfunded, and oftentimes they're underfunded because of the tax rules. Now, then there is something about the funding of the pension plans that it isn't that if you overfund them according to the IRS, that's not a temporary difference. It's a permanent difference. So if you put an extra $3 million into the pension, you can't write that off this year, and you can never write it off. It isn't like, okay, you have to wait till next year to write off that because you paid it too much. So they are kind of, and again, the reason is that these are giant numbers. It's not uncommon to have, like I say, pension funds that are way bigger than the company itself. So the IRS is very aware of the size of the numbers and all that kind of stuff. And oftentimes these are underfunded just because of tax rules. These are a huge amount of, they're gigantic dollars in a lot of these things. Okay, pension expense calculation. Something my spacing here. Okay, these first three are three that you will always have. The service costs. So this is what the employees earn in the current year. So in the current year, you have 50 employees. You all get one more year of service, and so whatever their pension goes up by, this is the current year service cost. The interest on the liability. These liabilities have a discount rate, just like any other liability. They have a kind of like an interest rate, basically. It's usually called like a settlement rate or something like that, but it's an interest rate on this. As all liabilities, as time goes on, there's an interest to be paid, and that's what this interest on the liability is. The expected return on plan assets. This one is a little odd, and I wish that this would go away, but it won't. Expected return on plan assets. We don't use the actual return. . we do put the actual return into a different journal entry. Just to make it more complex. Why they don't use the actual, I don't know. But the actual return is not used. They use the expected return. So if you're expecting to get 6.5%, that's what you use for your expense, your pension expense. It's what the expected return on those plan assets. And notice the more those plan assets make, the less you have to fund. You'd like to have it really, when the stock market's doing really well, companies that have these defined benefit pensions are really happy a lot of times because all those investments that are in the stock market, they jump up, they don't have to fund as much. So you want those plan assets to make some, a return, and that makes it for less. All right. This one is these don't always happen. A lot of times they don't happen the way we show them in the textbook. Amortization of unrecognized prior service costs. I'll talk about what that. Yeah, I'll talk about what that is now. Sometimes especially through union contracts and things like that, you get a change in the pension liability because, let's say they go to negotiate and they say, okay, well, you're going to pay us, you're going to pay out whatever, $2,200 a year for every year that someone works there. Well, let's say you renegotiate that, and through whatever agreement you come up to, instead of $2,200, you're going to pay in $2,400 a year. Now, notice there's people that have already been working there. They already have prior service. Maybe they've already worked there for 22 years. Notice that for those 22 years, we were using 2,200. Now we got to use 2,400. And for those same years that they worked here, those same 22 years, we got to use the higher rate. That's prior service. And so these prior service costs are service costs that are there because of previous work experience. But we gave it out today, so this liability jumped up today. And we have kind of a smoothing thing that we do with that. We basically say, okay, well, why did we give them this extra money for this prior service? And the idea is, well, we gave it to them because of the future service. So even though it's based on the prior service, we gave it to them based on, we want you guys to work for us, and this is why we give you this extra money to come back into work or whatever it was. So you kind of spread it out over the future service of the employees. And we'll see how to do that. All right. Down here. This is one that we have a journal entry for this every time for these actual gains and losses, but there's also a certain amount that if it goes beyond the normal amount, it goes on beyond the expectations by a lot, then we will have to put it into our pension expense. Usually these things don't go in the pension expense, and they often reverse out fairly quickly. And it can kind of come in two different ways. So you have this expected return on the pension plan. Let's say it's 6.5%. Let's say the plan jumps up 20%. Whatever it is, the stock market goes crazy. They have a few certain investments that really take off, whatever it is, it jumps way up. That unexpected gain, it has to be large enough that it's more than 10% of either the plan assets or the liability, the pension benefit obligation. It either has to be the higher of those two, whichever one's higher. It has to be at least 10% of that. We're talking about really big numbers. We're talking about what would have to be very large numbers. Anyone who knows anything about investments know that you don't, let's say he makes 20% one year, you don't make 20% every year. It's not uncommon to see 20% one year, and then the next year it's negative 8% or whatever it is. That's just the market, you know. So a lot of times, even if you have these where they go over the 10%, the next year they disappear. So, or within 2-3 years they disappear, whatever it is. So a lot of times they don't really hang around that much. And if you look at the stock market over the years, it usually goes up, but it doesn't go, a straight line. It goes up like, that. So this is one of those weird things. It's called a 10% corridor, but it doesn't. Actually don't have the actual gains and losses on those. They actually don't hit the books unless they go really big. If they go really big, then they get put on the books. Okay. All right. So let's kind of see a problem. And the first problem here is done for us. And by the way, I have everything in this first problem because if for those of you, if you look at this before you're studying for the CPA exam or something like that, I'm not sure. I don't think I'm going to cover all of these in the class, but this first one we'll have in here. In fact, I know I don't go into the prior service cost in the expense. I purposely took that out. Okay, so here is our pension. And we had beginning the pension benefit obligation was, this is the liability. Was 800,000 and the beginning plan assets were 760. By the way, is this overfunded or underfunded?
Underfunded.
Underfunded. Yep, this is underfunded. We have less assets, and this is very common. Let me do that. Okay, the settlement rate. So this is the interest rate we have to pay on that. Oops. That's the interest rate we have to pay on this liability. So it's a settlement rate. The service cost, this is what we this is what the employees have earned in the current year. And notice, this is our expected return on the plan assets. This is not the actual return. And here's the actual return on plan assets. Here's the actual return, but we don't use the actual return on the pension expense. We use, this is what we use here. Okay. Cash contributions to the plan is what the company, whatever company they are, is what they put into the plan. This is when they were up here, they put in 60,000. No, this was for it. I'm sure they put a lot more than 66,000, 660 million in or something more. But anyway, so this is the cash that the company put in, 66,000. Actuarial loss projected on projected benefits obligation. Okay, this is what they call an actuarial loss. This is a change in the settlement rate. So maybe the settlement rate was 11% last year. Now it's 10%. that would cause our liabilities to jump up some amount. Okay. Prior service cost. This is a wacky one that, again, I'm going to show you guys how it comes about. We are not going to do this by itself, but we will do this other one here, the one below it. So apparently we did some kind of negotiation probably with the employees and said that we're going to give them extra benefits based on prior service. So again, this is that when I was talking about where you say, okay, we're going to pay you more per year. So if you work for 22 years, you know, work's already done. That work's already done, but you're going to get more money because of those. So that prior service cost, we gave it today, but it's for service that happened 22 years ago. No, we're not going to go back and restate all those 22 years of financial statements. We're going to say, okay, we gave it to you today, so this is the cost today. So the cost today was $100,000. We're not going to recognize all of that today because we're going to do what they call amortize it. We're going to spread it out over the future service of the employees that are going to get it. So it's a big chunk of money today that we're on the hook for, but we're going to spread out the expense of that for however many years, for that $100,000, and we're going to pay a little bit. You know, we're going to expense a little bit each year. And the first year we have $20,000. Make sure I'm not lying to you. Yeah. So this is the $20,000. Says, okay, this is their portion of it that we're going to expense this first year. Okay, so let's kind of look at these journal entries. The first one here is for the prior service costs arising. This, we're not going to do this entry. Because we're not going to do it, I'm not going to bold it. No, but this is for that $100,000. So this would be a one-time deal. You would put this on the books, and this would go into not into income, but our other comprehensive income item. I've talked about comprehensive income in here, haven't I? Maybe not. Well, the investments one. It's kind of like a second type of income that everything goes into it. It's not net income. So when you give these employees that prior service cost, it does not hit your net income. The prior service, the total $100,000 goes into what they call comprehensive income. The amortization of that is what is the only thing that hits the income statement, and that goes through the pension expense. I know it's confusing, but yeah, the prior service costs are kind of messy. Okay, now the second entry here we are going to do. I can bold this one. Don't. All right. Well, it's not going to get bold, but anyway. So let's take a look at this. What this actually shows. First of all, you'll notice that we had, you know, here's our actual return on the plan assets. Our expected return was 98,000. Our actual return was 102. I'll say on assets. So this is an unexpected gain. Now this unexpected I don't know, unexpected gain of what, 4,000? Put in the dollar. So we expected to get 98,000. The actual return was 102. We got more return than we thought. So this will be an unexpected gain of 400. And let me make the. Now, we also had this actuarial loss. This is again due to the change in the interest rate. So what we do is we net those together. And that comes out to a loss of 9,000. So we had the $4,000 gain. We had the actuarial loss. And so we net those two together. We have a net amount of a $9,000 loss. And we put that in there. Other comprehensive income, gains and losses. This happens to be a loss, but the account they use will have both in there. This is going to be a loss. The pension liability, this is actually going to be a liability. It's going to be increasing. This other comprehensive income, this is a equity account. It's not on the income statement. So other comprehensive income is not on the income statement. Let me write that. Other comprehensive income. By the way, you often see this just called OCI. It's in the equity section of the balance sheet. Okay. All right. So this other comprehensive income. This is it doesn't go on the income statement. It goes on the balance sheet in the equity section. All righty. 10% corridor test. This is the last time you're going to see me talk about this. The cumulative actuarial losses are 25,000. That is the 9,000 that we just had. Plus, they tell us that there was 16,000 from previous years in there. I don't believe it. So the total amount of losses are 25,000. Now, the corridor approach says that we take the highest of these two. So the highest is the pension liability, whichever one of these two is higher. Pension liability is higher. We take 10% of that. And 10% of 800,000 would be 80,000. So until this loss gets up to 80,000, we don't do anything in the expense. So the corridor rule is really for very large swings. Do they happen? Yeah, they've happened, but and when they do happen, then they usually turn around the next year. Whenever you have a really bad stock market, it's usually followed by a good one. If you have a really good one, it's usually followed by a bad one. This is the way it is. So a lot of times those kind of reverse out pretty quickly. Okay. We don't have unadvertised losses that we were looking at, and we don't have, well, I'm sorry, we do have the private service cost in there. But anyway, you look at these, so the service cost, this is how the pension expense will be determined. And let's go through this, just to kind of make sense out of it. So service cost, this is the increase in the liability. The interest on it, we have interest on that liability that we had in the past. It'll also increase the liability 10%. The expected return on plan assets, this will decrease the amount of liability that's owed. I shouldn't say liability. This is deeply decrease. I'll say the net liability. The liabilities will stay the same, but this is going to cover more of them. And the amortization of service costs, this is recognizing more of the plus to the liability. Actually, the entire amount's been put in right immediately, but now we're recognizing it. And again, because we didn't have any problem with this 80% corridor, or excuse me, 10% corridor for $80,000, we don't have to do anything with this amortization of unamortized gains and losses. And so this is the pension expense, and this is the one we're going to kind of concentrate on. The other one is, this one is fairly easy up here. Oops, not that one. This one, but this one is obviously more involved. You'll notice there's something in here, or actually, you'll notice what's not in here. What is not in here is how much cash they actually put into. Where'd I go? Went right past it. I'm sorry. Notice that this cash contribution of the plan, this is not in there. It doesn't come into play for the expense. You can have pension expense even if you don't put any cash into it. And by the way, that when the stock market is doing well, you'll often see that. So here is our, hey, it didn't get messed up. So here's our journal entry. Well, first of all, let's look at the 72,000. That's what we came up with. Pension expense. Cash, how much cash we throw into it. And this is our other comprehensive income prior service cost. So this is what we're recognizing as part of the expense, but it's also decreasing because we're recognizing it. It's decreasing this pension liability. So we're recognizing it. We're taking it out of our other comprehensive income prior service cost, and this pension liability is being decreased because of that. All right, let's do it on our own. How about that? It's something weird with the spacing here. Or maybe not. Oh, great. What did I just do? It goofed it up. Okay. So look at number 5 here. So these are contributions to the plan. So this is what they paid into the plan. Beginning PPO and plan assets. Oops. Oops. We're underfunded here, right? Here's the liability. Here's how much assets we have. So this is underfunded by what? 120,000. And again, that's not uncommon. Okay. Service cost, that's in the current year, when employees earned in the current year. Settlement rate for this EBO. Expected return on planned assets, 65,000. That's what we're going to use in our expense. It's going to reduce our expense. The actual return, we will make a journal entry for that, but we will not include it in our pension expense. We don't have any prior service costs. Yay! We have an actuarial gain of 10,000. Yay! Our accumulated other comprehensive income is a credit. That's a gain. And I'm going to leave that one. Okay. So we expected to make 65,000 for our plan assets. We actually made 62,000. Is that an unexpected gain or an unexpected loss? Oops.
Loss.
Yep. What, 3,000? Now we are going to compare that to our actuarial gain. Make that green as well. So these kind of all go together. So we had this actuarial gain. That's when they changed the interest rate. They probably changed it from, I don't know, 11 down to 10 or whatever, and it increased the liabilities. And we had this unexpected loss of 3. So what did that net out to? A gain or a loss?
Be a $7,000 gain.
So coming back up here to kind of look at, this other comprehensive income gains and losses. If it's a debit, it's a loss. If it's a credit, it's a gain. So we're going to use the same account, other comprehensive income. I think I'm going to start calling this OCI just because it is quite long. And by the way, you'll see it listed as OCI even on financial statements. So other comprehensive income, actuarial gains and losses, we will put that in our journal entry. That will be the credit. It'll look funny. And losses, oops. 7,000. And the other side is going to be this pension liability. Now notice, liabilities go up with credits. So this pension asset liability, this is either going to reduce the liability or reduce the planning, the pension asset. I just realized I should start putting that on these problems. Put what actually is sitting in the pension asset, the pension liability or asset account. Because it could be either, depending whether it's a debit overall or if it's a credit overall. Okay. So this one is just for these kind of actuarial gains and losses. These are things that happen throughout the year. And the company really doesn't have any control over those, which is probably why they have it run through the equity section rather than through the income statement. But it does seem kind of strange that those don't just, that this doesn't go into the pension expense. And my guess is because these could be very large amounts, depending on what happened. And the company doesn't have really too much control over that. Okay. Pension expense. This is the one that we came for. Okay, this is, I didn't format these right. This should be centered. I gotta stop redoing. I do redo my handouts like every single class. I should just leave them. Okay, so service costs. Um, 200,000. Interest on the benefit obligation. So this was the benefit obligation at the beginning of the year. We use a interest rate, they call a settlement rate of 10%. What is it? 82,000? So this will be our interest on this benefit obligation. So we're going to have to kick in another 82,000 at some point to pay this off. So 82,000 will be added in. These are pluses, by the way. Expected return on plan assets. This is sort of like our getting out of some of these payments. Our expected return was 65,000. So if you're talking about the net liability, in other words, what we're actually on the hook for, this return on plan assets reduces how much we're going to have to pay in. So this is going to subtract from. And again, the weird thing about this one is the expected, not the actual. The actual, the difference between those was actually taken care of up here. but for whatever reason, it's not in the pension expense. Amortization of prior service costs, I don't think we have any. We don't. So this would be 0. There are no cumulative gains and losses. These two together would be 14,000. It would have to be at least 82,000 to kick in, and we don't have it. Okay, so all these together will be our pension expense. Oop. $217. So it'll look like this. Pension expense. We paid in cash of 180. So this is cash going out. I don't think I put that in there. Okay, so 180,000. So this will go down here. And we don't balance. What do we need? We need a credit of 37,000. And so this will go into our pension asset, pension liability. This is a plug number. And but basically what it's saying is we're on the hook for 217,000 more. We paid 180,000. So we're gonna have to put on the company's books. So this is, you know, this is for the pension, but we're gonna put on the company's books that they owe an extra 37,000. Now, we wouldn't have any more liability if we had paid the whole 217,000, we wouldn't have this other liability going on the books. But whatever the reason is, could be for taxes or whatever. They didn't, you know, they paid 180. So this pension asset liability, in this case, is a liability. Going up by 37,000. Well, actually, it's hard to say because if they have a pension asset on the books instead of a liability, it would be a decrease in the asset. But regardless, this is bad news. Whether it's reduction of assets or an increase in liabilities, you know. And notice if they didn't put any cash in, they would still have the pension expense of 217. It would just they'd have pension asset and liability on the books for 217. And this would be 0. All right. Let's take a break. Let's say be back at 7-Eleven. Put it up here and put this up so you guys can look at it. Okay, let's do another one. Okay, we'll first have to do the let's do the plan assets. Um, do- Okay, for the plan assets, do we have an unexpected gain or loss?
Loss.
What is that, 7,000? And we have an actuarial loss of 17,000. So the total for the journal entry is going to be those two together. Was it 24,000? Loss. So sorry, I'm sneezing like crazy again. Total loss is 24,000. Okay, so, and we have other comprehensive income, we actually have a gain of 8,000, so if we netted those two out, it'd be 16,000. If we look at our plan assets and our obligation, 10% of those 120, there's no way we get to that corridor. In fact, I'm probably gonna stop talking about the corridor because I don't think any of these I gave you will have that corridor in it. Okay, so let's see, the total loss was 24,000. Oops. Nice spot. And the corridor. By the way, there is something unusual about up here. These two. What's unusual about the PBO and the plan assets? Is it underfunded or overfunded?
Good.
It's overfunded. They have more assets than they have liabilities. And they're still throwing, looks like quite a bit in there. Okay. So let's come down here to the pension expense. The service cost. I forgot I have to. Service cost was 240. Again, this is in the current year. People working through the current year, they accumulated a total of 240,000 of additional benefits. Now, those obligations we have for people in the past, those have also grown by 8%. Okay, so I'm going to take the PBO times 8%. Oops. $88,000. Yep, 88,000. So this has grown by 88,000. Our expected return on plan assets, again, wacky, it's expected, not the actual. The expected return on plan assets, 125,000. And these two are adding to the expense. This one is subtracting from the expense. Okay, amortization of prior service costs. We do have this. I saw it somewhere here. Okay, we do have this amortization of prior service costs. What this means is at some point in the past that we gave them an extra bonus because of the service they'd already performed. But we're going into the future now, saying the reason we gave it to you is because of these future, you're going to work for us in the future. So we are going to amortize a certain amount of that until it's all gone. So amortization of prior service costs, 9,000. So that will add to. And we don't have any losses or gains. Oops. So our pension expense will be whatever that is. Did I do that right? I'm off by 10,000. No, yeah, okay, that is it. Okay, so our pension expense. We made contributions. 230. So that'd be cash. So these are the contributions. And these are also an asset going down. Just that quick, I forgot. 230,000. Okay, so here is the kind of strange thing about this amortization of prior service costs. And that is when this first happened way back in the day, we put it on as a liability. Now we're recognizing it in our expense. So we are basically going to be taking it off of our liability, and I'll do it through. No, I'll show you. Yeah. So there's 9,000 in this 212. We're matching it over here. When we come up with this pension liability, or pension asset, pension liability, notice that 9,000 is already, it's already in the pension expense. It's already in the liability. So this is sort of like keeping it from being added to the liability twice. Or in this case, I think it's going to be an asset. What is it? 39? Yeah, 39,000. 239 minus 212. $37,000. This is a plug number. And again, we're expensing this 9,000. It's already in here. It's already in the liability. I'll show you what I'm talking. When we first have this, we first put this on the books as a one-time deal. First put it on the books. It already is in the pension liability. So, oops, so when we come down here, that's why this is being taken out of basically of what is owed. It's already on the books as a liability. We don't want to, if we didn't put that in, it would be basically putting it in the liability twice. Question on that thing? All right, let's do one more. Unusual about this one. I don't think so. Let me see. Okay. Okay, so let's look at the plan assets, unexpected gain. $8,000. And the net would be what? This is a loss, so the the net gain would be 6,000. Okay, so, and by the way, it looks like we have another comprehensive income debit. This would be a loss of 8,000, so it's net out to 10%. I should quit talking about it. 10% of the smaller of the two would be, excuse me, the larger of the two would be 57,000. There's no way this is close. Okay, so net gain is 6,000, so we'll have other comprehensive income. Yeah. Well, this is the gain. There. Okay. Pension expense. Service cost. Here. Service cost 100,000. So that's what people earned in the current year. Oops. Now, this past obligation also increased by 10%. $50,000. So basically, we owe the people $150,000 more. This is what they earned in the current year. This is what they earn. Basically, their liability earned, for them. So we owe them another $150,000. Now, we had our expected return on assets of 40,000, and again, the expected return, not the actual. So these two will add to it. Amortization of prior service cost. We don't have any, do we? Oh, we do. Yes, we do. That's what I meant to say. We have some. We have that. 10,000. That's gonna add to our expense. We're recognizing 10,000 of that. Yeah, we don't have. $120,000. I think. Yeah, 60,000 minus 40 is 20, right? Okay. I spent 120,000. Cash we paid in. So this is cash here. So it's cash going down by. Forgot what it was. 90,000. Our amortization of prior service costs. $10,000. It's already in our liabilities. And so this would be a liability. Oops. Fund number. Let's stop. We'll do more of these next time. It's a wacky, it's kind of wacky. There's a lot to it. And part of the reason why it is so wacky is that you're really talking about just astronomical figures a lot of times. There was serious discussion when when the pension rules came out that it was going to bankrupt, half of the U.S. companies. That they weren't going to be able to get funding because they had all these huge liabilities on their books and all the stuff. So, one of the clever things was having the pension plans being shown as separate from the company. That way, those huge amount of plan assets and especially the huge amount of liabilities would be kept away from the company, basically. So that if you're wondering why it's kind of strange, that's why. And again, the pensions in many companies are larger than the companies themselves. Especially older industrial companies. And the state of Illinois. State of Illinois is that. State of Illinois had a weird thing where they would, teachers' pensions would be basically turned over to the state. And so a lot of times they had teacher contracts and that when they negotiate anything, it was, hey, we'll make your pension more generous. And that was because the state was gonna pick it up. And so he ran into these very, first of all, overly generous, not I should say overly generous, but very generous pensions because it was, the whatever the district wasn't gonna pay for it. So a lot of times you had these kind of strange things that led to this kind of stuff. And again, you're talking about 1950s, 1960s, probably wasn't that big a deal. How much is it? Ah, sure. They'll retire, they'll live a couple of years and die, and we can handle that. So it's one of those things. It wasn't, they're gonna die in 2 or 3 years, they're gonna die in 20 or 30 years. It wasn't uncommon to have people die in their 50s, a lot. Just the way it was back then. So anyway, fast forward to now, and these are absolutely massive. If you look at these pensions, a lot of times it's almost like lottery winnings or something, because they're so big, they're paid out for life. And if you actually were to calculate what they're worth, a lot of times it's in the millions. That they have at least as liabilities. Okay, any questions? All right. Well, let's call it a night, and we'll come back next week and do a couple more things on here, and then we'll have a practice test, but pensions and taxes are gonna be the only 2 things, and I think I'm just gonna give you guys problems. I don't think I am. I'm just gonna give you guys problems on them. Just make sure you can do these. And as far as memorization and all that kind of other stuff, the multiple choice kind of stuff, when you guys take the CPA exam, if you do take the CPA exam, definitely you'll really crack down and memorize those things. Even if you did learn them now, you're not going to remember them when you take the exam. So anyway, but anyway, hopefully you get a good grounding in the nuts and bolts of how deferred taxes and pensions work, because those are actually 2 pretty big things in business. Okay, any questions? Okay, see you in a week.
Have a good night, Professor.